Hello there, welcome to this edition of Global Business Africa. In the course of the hour, we'll run through the business news stories you need to know about from the continent and beyond. But first, a quick update on the markets for you. So the mining majors, Anglo American and BHP Billiton in South Africa, over 2.8% lower today, dragging the top 40 that little bit lower. So far in the quarter, though, the top 40 has gone up by about 11%, recouping effectively all the losses from around late November, when South African scientists sequenced the Omicron variant of COVID. The Nigerian All Share and the massive free float over in Casablanca, they're both in the red today, but remember, these are both over 20% higher on a year-to-date basis. 2021's not been bad for those two. Nvidia shares around 5% lower at 1611 GMT in the wake of news that the Federal Trade Commission would sue to oppose its $40 billion takeover of the SoftBank-owned chipmaker ARM. The thinking apparently in Washington is that will dent competition. Here's what's coming up tonight. The IMF is warning of imminent economic collapse among some low-income economies. We'll explore how Kenyans are struggling to cope with a rise in inflation. And crude prices have recovered today as the OPEC Plus cartel fails to review its production cuts. All that and more is in the pipeline for you tonight. But let's start with a story with a continental view, specifically African debt. The IMF chief, Kristalina Georgieva, is urging advanced economies in the G20 to extend and improve their debt relief initiative. Now, she's warning that many countries face a dire crisis without help. Georgieva did not specify exactly which economies had her deeply concerned, but she simply referred to low-income countries. Now, the G20 Debt Service Suspension Initiative, or DSSI as it's more commonly known, expires this month. And without renewal, the IMF says countries will face some pretty severe financial pressure, spending cuts, or even economic collapse. Now, this comes as a new variant of COVID-19. The Omicron one is spreading and interest rates are also expected to rise. The G20 has twice extended the DSSI, but the IMF and the World Bank have been urging creditors to do a lot more to help low-income economies deal with their unsustainable debt loads. There are 73 countries that are eligible for relief under that program. Let's explore this problem in a bit more detail. Bartholomew Armour is the Director of the Macroeconomics and Governance Division at the United Nations Economic Commission for Africa, or UNECA as it's more commonly known. He joins us now live on the program tonight. Thank you very much for your time this evening, sir. So with respect to debt across the continent, only 3 countries, that's Chad, Zambia and Ethiopia, have applied for debt restructuring under the G20 common framework. But is there a sense of denial here among policymakers among the other 18 countries that are at high risk of or already in debt distress?
Yeah, thank you for having me. Yeah, it's a very important question because the common framework, as you rightly pointed out, was developed after the DSSI came into vogue, so to speak. And the countries that initially went for the DSSI, for the common framework, particularly if you take Ethiopia, I think their experiences perhaps served as a signaling effect for others who might want to have done the same. And one of the challenges, at least from the Ethiopian experience, is that when Ethiopia opted for the common framework, what happened was that the yields on Ethiopia's sovereign bond increased by 2 basis points. So basically, there's a sort of a penalty on the markets for countries that opt for the common framework. Besides issues of coordination among the creditors to actually agree a deal in terms of what the nature of the debt restructuring.
But isn't that to some extent a bit of a red herring, sir? Because if you think about it, it's either we take the hits now with our yields going up to some extent, or we end up having to deal with a major restructuring 3, 4, 5 years down the line. I mean, on balance, it seems like a fairly straightforward choice.
Well, it's a cost-benefit analysis that the country has to make. The point is that most of the debt that these countries are facing is increasingly from the private sector, right? The common framework is largely a public debt-driven agenda. if you look at Africa's debt since 2010, it went, about 10% of the debt was private, and now it's 40%, 150 billion. So now the Commons Framework calls on the private sector and other non-Paris Club members to provide comparable terms. Now, I mean, it's up to them to decide to do that or not to do that. So you take a hit from the credit rating agencies, and you don't have access to private capital markets, which are increasingly your key source of financing. So, I mean, the framework itself has to, from the beginning, be designed with an integral role for the private sector so that they don't come in at the tail end and disrupt the whole process. Because, what's the point in having a framework that cannot be implemented because the key creditor is not at the table?
We've seen Chad as an example of that, because I mean, it got to a point where the IMF had to come in and actually publicly chide Glencore and tell them, look, you've got to essentially give the country some slack here. You've got to restructure the debt that Chad has in place. Should we expect to see a lot more of that happening across the continent?
Yes, I think we should, and we should even see this framework being extended beyond the low-income countries. In fact, if you take the DSSI, it had a similar challenge. I mean, not all countries that were eligible took the DSSI because they did a cost-benefit analysis and said, look, I mean, if I take the DSSI, yes, I get the can kicked down the road for a couple of months or years, but if I focus on maybe trying to restructure and really put together a package to get more resources from the private sector, I might be better off. So countries made that calculation. And really it comes back to the fact that the debt landscape is changing rapidly. However, the debt architecture has not changed commensurate with the changing debt landscape. So the private sector is becoming a key player because they have the trillions. The public sector cannot match in terms of the amount of resources that countries need. And countries are graduating in terms of their resource needs. However, the system has not really caught up to that new changing landscape.
To what extent is a lack of transparency part of a problem in trying to sort out our debt problems across the continent? Because you're seeing in a lot of countries, you end up with a situation where, like Zambia, for example, where now we find out after we have a change in government that actually what's due to China is actually much, much larger than was expected. Or the case of Mozambique, where we had billions of dollars essentially being hidden that was borrowed from VTB and Credit Suisse. To what extent is that lack of transparency an incentive for governments to say, let's just keep kicking the can down the road, ride it out, perhaps with COVID essentially disappearing and taxes going up, this problem won't be as severe in a year as it is now?
Well, the lack of transparency manifests itself at least in one way. Is the debt public or is it private? I mean, that sorting out of that itself has been a problem because, the DSSI initially is really about the public debt, and then they call on the private sector to do provide comparable treatment. But the public debt, which has the more immediate, it lends itself more immediately to the debt suspension, is a little bit more clear. But if you can't sort out the two, that becomes a problem. Now the question then is, I mean, how are these loans contracted? And on whose terms and on who is responsible for making sure that this debt is transparent? I mean, you would think that both parties really need to be part of that. But yeah, the short answer to your question is, yes, the more transparent the debt is, the more we can sort out what is private, what is public. And then when we are actually doing the restructuring, you can actually tailor your responses to the different debt categories that a country has.
Okay, one last question for you, sir. We often tend to hear, at least in our circles, when we talk about these macroeconomic issues, okay, you've got a debt problem, you need to raise more tax revenue domestically. But at a time when you've got 30 million more Africans who are essentially in extreme poverty, you've got growth slowing down, you've got inflation eating into real incomes across households and slowing down economic activity. Is that really a realistic alternative for a lot of economies in Africa?
Well, I mean, it's not about whether to mobilize more resources or not. It's about how you do it and where the incidence of the tax falls. I mean, there is clearly a situation where there's a tax gap, in the sense that the tax potential of Africa has been estimated at least 20% of GDP, but we're operating around 15, 16%. And so there's a gap, clearly, even before COVID. So I don't think we should use COVID as an excuse. I mean, there are clearly certain parts of the system that are not paying their due tax. And then there's also the issue of illicit financial flows. So, I mean, where, resources are being siphoned out of the countries, estimated 50 to 80 billion a year. So, I think there's scope for domestic resource mobilization that needs to be complemented by external resources. And we shouldn't let governments off the hook just going external without really also optimizing domestic resources that can be mobilized for development.
Indeed. It's been an interesting conversation. Thank you very much for making the time for it. Bartholomew Armour is the Director of the Macroeconomics and Governance Division there at UNECA. Now, the International Monetary Fund says the Ugandan shilling is moderately overvalued. According to data from the Washington-based lender, the Ugandan currency is up about 3.5% against American dollars so far this year. Effectively, that makes it one of the best performing currencies on the continent. From Kampala, here's CGTN's Michael Baleke.
In what has been a tumultuous time for currency markets, the IMF says Uganda's currency has been very stable and is performing at its best. The gains made by the shilling are largely attributed to widespread global uncertainties like reduced import demand linked to the COVID-19 pandemic. Some analysts argue fiscal stimulus measures introduced during the COVID-19 crisis has created an oversupply of dollars in markets like Uganda.
In terms of portfolio flows over the last one year or so, they've been on the upward. Currently, numbers indicate about $800 million of portfolio flows, which are investments in bonds and treasury bills. That's a huge amount. It is anywhere about 10% of our total stock of debt.
Uganda is currently experiencing a bumper crop harvest. This has seen the country's coffee exports increase in both value and quantity. And the government says the economy is on a recovery path after 2 years in distress due to COVID-19.
We want to work on getting Ugandan economy to change its structure, to modernize the economy, to ensure that we stop relying on subsistence agriculture and be able to commercialize agriculture, industrialize the economy, and also build our export potential.
Data from the Coffee Development Authority shows the country exported coffee worth more than $650 million in the year ending October 2021, compared to just $500 million the year before. The increase in the supply of dollars, according to the IMF, has also pushed up Uganda's foreign exchange reserves to $4.4 billion from $3.6 billion in June. The IMF projects that excluding oil-related financing, the reserves will remain at about 4 months' worth of imports. However, the emergence of new COVID-19 Omicron variant is something financial analysts say needs to be watched.
Markets, economies were starting to open up. Some of them are now saying, look, we need to be cautious in how we open up. So will this cause more lockdowns down the road, disrupt supply chains? What is likely to happen? Perhaps it's too premature to talk about the outcome of all this.
The recent signing of the oil and gas deals between Uganda, Tanzania, and joint venture partners that include France's Total and China's Sinopec is expected to open up investment space, a move likely to keep the shilling even stronger. Michael Baleke, CGTN, Kampala, Uganda.
South Sudan says it is taking steps to protect the environment even as it extracts oil to develop the country's economy. The government depends on oil revenues to fund nearly its entire budget. As CGTN's Patrick Yates now reports from Juba, the country is looking to increase its crude production to over 300,000 barrels a day by 2023.
South Sudan's government says a total global ban on petroleum production would leave the country without the much needed resources to propel the economy forward. This comes at a time when 7 European countries have pledged to stop support for fossil fuel projects abroad.
The Ministry of Petroleum, in collaboration with the Ministry of Environment and our developmental partners, has taken a significant step in maintaining the balance between the economic growth, developmental needs of this great nation through continuous extraction of hydrocarbon resources and the spirit of environmental stewardship.
The effects of climate change resulting from activities such as oil extraction and the use of petroleum are not sparing South Sudan's environment. The United Nations reports that nearly 1 million South Sudanese people are displaced this year due to the flooding. Crops and livestock have been washed away as well, exacerbating an already dire food security situation. Water pollution from oil is also killing off livestock.
We were engaging with the government, especially the Minister for Petroleum, that for any investment to happen in South Sudan, this investment must be able to generate income, which income needs to go and finance key service delivery sections. And some of these issues we're talking about that are actually peace dividends, we need the investment to be able to go and build our roads. We talk about electricity, we talk about the health sector, we talk about the education sector. Much importantly, money must be earmarked for investment in agriculture.
South Sudan's government says approximately 90% of the country's oil and gas reserves remain unexplored. The government is calling on foreign investors to a country that is already home to oil and gas majors from China and Malaysia. It says it has made significant progress in returning the country to peace and stability, and that should encourage investment in the petroleum sector. Patrick Koyet, CGTN, Juba, South Sudan.
Right, and a quick run through some company news. Let's start in healthcare. The Kenyan e-health startup MyDawa has received a $1.2 million grant from the Bill and Melinda Gates Foundation. Now, the grant aims to increase access to pre-exposure prophylaxis services, or PrEP access, through its e-pharmacy model, effectively supporting the fight against HIV and AIDS. To date, the foundation has committed over $3 billion in HIV grants to organizations worldwide. Elsewhere, Zambia's state-run airline, Zambia Airways, returned to the sky this week, nearly 30 years after it was liquidated back in 1994. Now, it resumed operations after the Zambian government signed a shareholding agreement with Ethiopian Airlines back in 2018. Its Bombardier Dash 8 Q400 aircraft made its maiden flight from the Kenneth Kaunda International Airport in Lusaka to the Simon Mwanza-Kapwepwe International Airport in Ndola, where the country's copper industry is clustered. ABSA, on the other hand, has posted some pretty strong credit growth in the 10 months ending on the 31st of October. Now, it expects headline earnings in its biggest business, that's the retail and the business banking division, to more than double on a year-on-year basis. ABSA's share price jumped by more than 5% to roughly $10 a share, nearly trading on Friday in the wake of that trading update. And the Southeast Asian unicorn Grab had a rough day. Well, rough day one, really, on Wall Street. The Singaporean startup closed down nearly 21% on Thursday as it started trading on the Nasdaq. Grab went public by merging with a special purpose acquisition company. The deal was valued at nearly $40 billion. It is the biggest of its kind on record. That's a run through your company headlines. Well, 20 minutes into the hour, you're watching Global Business Africa. Time for a short break. Here's what's coming up. We'll explore how Kenyans are coping with a surge in inflation. And Egypt's central bank will help industry source raw materials amid supply chain disruptions worldwide.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global Business, only on CGTN.
So this is it. I'm just about to be shot.
Tents here, bottles are being thrown. As they do so, we
there are about 3 critical bridges here in Malawi. That's one of them. We're going to cross that bridge.
As you can see behind me, police forces
who are replying with gas. Gas just came in.
Tear gas, so it's all begun now.
Divisions leading the charge into West Mosul have brought us here.
Just
got to be careful here with some gunshots.
This is where most of the fighting has been concentrated.
This is the front line now after 9 days of fighting.
We're about 2 to 3 kilometers from
within
the front
clear
line.
view of this front line position.
There's more to this place than just glorious landscapes. There's more to it than just, say, Table Mountain or glorious, endless salt flats. There's more to it than countries that are home to some of the deepest mines in the world. There is so much more to this place, even if it is home to some of the finest diamonds on the planet. It is the sheer diversity of the people who call Southern Africa home and the relentless drive to make it a better place that make it so special. And we know that because this too is home. No one knows Southern Africa like we do. CGTN, see the difference. Welcome back to the program. Consumer prices in Kenya are rising, with petrol and food prices leading the charge. Data from the National Statistics Bureau over here shows that inflation averaged around 5.98% in the first 6 months of the year, compared to 5.31% in the second quarter of 2020. Economists say that this inflationary squeeze could extend well into 2022 amid global supply chain crises and a crippling drought in Eastern Africa. With that report, here's CGTN's Najma Abdurizak.
Brace for tough times. The message to Kenyans as consumer prices across the East African nation rise, from gas stations to food markets.
For example, like tangerine is a fruit that has increased the price because we used to sell it at 350 and currently we are selling it at 450. So if you see, the increment is of 100 shillings, which is more.
In the capital, Nairobi, it's especially dire. To get about 4 pieces of these oranges here at this market is costing about 150 Kenyan shillings. That's about $2. While such prices will attract shoppers in the developed world, many Kenyans live on less than $1 a day, keeping these fruits and vegetables off the tables of many. Prices for other basic commodities like sugar have also gone up by up to 30%. The worsening cost of living in Kenya has been compounded by the COVID-19 pandemic, a weakening currency, and most of all, rising petroleum prices. Over the last few months, motorists like John Jenga have been forced to dig deeper and deeper into their pockets after fuel prices hit a historic high in September.
Kenyans are struggling, especially we boda riders. Prices are going up every day. It's becoming increasingly hard to do business these days, but we're still hoping for prices to drop soon.
The situation has been worsened by a weak shilling that has been trading above 112 units against the greenback since November 12. But as Kenyans now head into elections in 2022, many are worried the current financial pressure could take a turn for the worse.
I believe that the pressure will still be high on the cost of living. We still are not yet out of the woods in regards to global oil prices, and there could be a subdued demand in the economy, or even those supply chains might be curtailed as uncertainty around that particular event escalates.
The Kenya National Bureau of Statistics' latest report shows that the cost of living in Kenya eased to 5.8% in November. Economists, however, expect consumer prices to extend well into 2022 as global dollar scarcity activated by the festive season piles pressure on the local currency. Najma Abdurizak, CGTN, Nairobi, Kenya.
Still in East Africa, Tanzanians are facing power cuts. Now, this comes after the state-run Tanzania Electricity Supply Company, or TANESCO as it's known over there, revealed that water levels in many of its dams have fallen significantly. Now, drop in rainfall that the country's been receiving has also affected hydropower output, and that in turn has, of course, cut power output by more than 20%. CGTN's Daniel Kijo has the details from Dar es Salaam.
Like millions across Tanzania, Jimmy Mwasomola depends on electricity to power his business and feed his family. To print photos, do engraving, use his glue gun, heat press, and more, 90% of his machines depend on electricity. But recent power outages have resulted in his business suffering.
All my machines here cannot work without power, so on days when we don't get electricity, I lose a lot of work and money as well.
State-run Tanzania Electric Supply Company Limited says the drop in power generation is caused by the declining water levels in hydropower rivers and dams. Power generation has dropped by 345 megawatts, which is equivalent to a 21% drop in daily power production.
We have about 60% of our electricity that comes from gas. So we have electricity generated from gas as well as water or hydroelectricity. In the case of hydroelectricity, the country depends on 40%. So not having electricity now means the 40% that comes from water sources has gone down.
Economists say, as a middle-income country, Tanzania needs to have energy production alternatives, especially when it comes to water supply. Projects like the construction of the $3 billion Stigler's Gorge Dam is being undertaken by a consortium of El Swedi Electric Co. and Arab contractors, both Egyptian companies.
You know, the Stigler's Gorge project has more megawatts. Once it's done, we will get enough electricity for the country and even some we can sell to neighbours. If the project is managed well and completed, we will forget these electricity shortages.
Officials from the Energy Ministry have attributed climate change as one of the causes for power rationing and the current shortage of water in Tanzania. Power utility company TANESCO is installing additional natural gas-powered plants to ramp up power generation by 345 megawatts. The company is also fast-tracking the maintenance of its power stations to increase electricity production. Daniel Kijo, CGTN, Dar es Salaam.
Let's get into a story that's right at the intersection of education and finance now. Opportunity International, it's a Chicago-based nonprofit, has mobilized about $2.3 billion to support some 8,800 schools in some 30 low-income countries. Oiko Credit, a Dutch impact investor in emerging markets, will back Opportunity International partners, making loans to improve school infrastructure, support teachers and bolster tuition aid for students as well. Now, the partnership aims to increase access to affordable education for an estimated 1.6 million children in low-income countries, including Ghana, Kenya, Nigeria, Senegal, and Uganda. An estimated 260 million children around the world are still out of school because of the pandemic, according to Opportunity International. That's pretty close to the UNEP figure of around 257 million as well. Now, the non-profit's EduFinance program has provided over $440 million in loans to help keep some 2.8 million students in school. Let's explore that in a bit more detail. Caroline Mulwa is the investments manager at Oiko Credit, covering Eastern and Southern Africa. She joins us now live on the program. Caroline, good to see you on the program. So, as I understand it, the cash is going to be on lent to schools and to families. But what are the terms and the price for this support?
Thank you very much and good evening. The terms of these loans are going to be very much dependent on the financial institutions that we support. As you know, this fund is going to be able to reach quite a number of children and schools across 5 countries in Africa. And all these markets are different. And so the institutions will be from different countries and they will be providing the loans to families and to schools based on the market rates of those specific countries.
So essentially, are these sort of being benchmarked to what retail lending rates might be in that country or slightly below that?
Yes, that's true. We believe that schools can be run as sustainable institutions. We believe that if schools and head teachers are taught how to manage their schools well and how to ensure that there is a positive outcome on education, then what happens is that there is an increase in the enrollment. And once the schools are run in a sustainable manner, they can be able to pay loans. So we do not believe that there needs to be, for example, subsidies on schools. As long as they are managed well, they can be able to repay. their loans.
Walk me through how that would work, because I'm trying to think of a situation like what we tend to have here in Kenya, where virtually every quarter I see stories coming out where schools are saying, look, we've got problems because we haven't gotten our capitation coming through from the government, where you have teachers who are constantly complaining about issues of pay. I mean, on aggregate, it seems like there's a cash flow problem across the education sector, yet you're saying, well, we think there's a business opportunity here.
Yes, indeed, we are. So what's going to happen is that Opportunity International will provide technical assistance to the financial institutions that we work with. And on a second level, they're also going to provide technical assistance to the schools that work with those financial institutions. Over and above that, Opportunity International is going to bring together the education ecosystem. So anybody who's providing transport to the schools, for example, people who are manufacturing uniforms and school books. And so these financial institutions will have a much larger ecosystem from which to tap from, and that creates sustainability. The schools, on the other hand, will also receive quite a bit of technical assistance to support them to improve their education quality, which means that they will have an increase in enrollment. Over and above that, we are targeting private schools, so we are not going to be targeting the government schools that seem to have a cash flow problem on an ongoing basis. So we are targeting private but affordable schools.
With respect to suppliers, is that a debt facility that you're going to be providing to them, or is this an opportunity for you to provide factoring services for them, given the sort of supply network that they're essentially already working with?
So with the technical assistance that Opportunity International is going to provide, financial institutions are going to create tailored products towards the education ecosystem or value chain that they will be supporting. So if the need is in factoring, if the need is in working capital, if the need is in asset finance, maybe to buy machinery for printing books, whatever the need will be, we will try in as much as possible to match the funding to the need on the ground.
Are there any partial credit guarantees in place to support this program?
At the moment, there isn't, but the way we are looking at it is we are trying to look at this partnership as a holistic partnership. And so what that means is that when Opportunity International provides all the technical assistance to the financial institutions and to the schools, that's going to be fully free of charge. And that means that it's already creating a subsidy or a partial guarantee. It's going to be able to de-risk any perceived risk that there may be in lending to the sector. And because the products are tailored specifically for the different actors in the value chains, we believe that there is actually a de-risking factor that's going to take place.
All right. Can you give us a sense of what sort of performance targets you're looking at for the program, at least over the next, say, 12 months?
We are looking to actually run the program for 3 years. We want to start it off in Kenya, in Uganda, in Senegal, in Ghana, and in Nigeria. So those are the first 5 countries that will benefit from this fund. We are looking to utilize about $20 million in each of these countries, and we believe that there is a need like that. We want to work typically with 10 to 20 financial institutions in each of those countries that would then be able to reach approximately 1,000 each within the education ecosystem. So that's what our targets look like. And in there, we believe that there will be students who will benefit from student loans. We believe there will be teachers who will benefit as well from school fees loans, because teachers want to keep on improving themselves, as well as the entire ecosystem, as I had described earlier.
All right, we'll leave it there for the time being. Caroline Mulwa, Investments Manager at Oiko Credit, covering Eastern and Southern Africa. Thank you very much. Now let's head over to Egypt. The central bank over there is pledged to support the country's private sector to be able to source raw materials amid rising prices caused in part by an energy crisis, but also COVID-induced supply chain limits. Under the agreement, banks will provide low-interest loans or grants to factories to import costly raw materials. They'll also be able to restructure outstanding debt, as CGTN's Yasser Kim now explains.
The central bank's multi-billion-dollar initiative is targeting the manufacturing sector, including both the large companies and small and medium-sized enterprises. The aim is to support plants whose production has dropped because of a shortage in raw materials and increase in energy prices due to the pandemic-induced fallout that has caused disruptions in the global supply chains.
We have around 23, 24 sectors. If we're speaking about all the industries or all the industrial sectors in Egypt, everybody has been affected. However, triple effect would be for food industries because commodities go directly into the food industry, number one. Cost of energy also affects.
Kamal El-Dessouqi's firm is one of those facing a supply shortage. His company deals in the manufacturing of building materials.
There's no doubt the severe confusion in supply chains have increased global energy prices, raised shipping costs, raised the prices of raw materials, petrochemicals, minerals and others which have all directly affected us. Though we do have reserves as we were expecting such a crisis, prices will no doubt have to increase.
The central bank has been heavily involved in bailing out the private sector in the last couple of years, pledging a $12.5 billion anti-coronavirus emergency fund in 2020 and a further $10 billion in 2021. And now it has pledged to intervene once more, although it did not disclose the amount.
The main parameter that the central bank is actually advising all banks to work with is number one, leniency or increase the facilities for the industries in the sense that it would cover for the increasing prices. Number two, they will tend to also lengthen the time loans for facilities to give them a breath of fresh air in order to be able to maintain the operating cycle of the industries.
The central bank is also supporting idle factories by financing outstanding energy and tax bills, as well as restructuring debts to avoid further defaults and help them resume operations.
As a medium-sized enterprise, we will certainly benefit from this initiative. Reducing interest rate on loans to the industrial sector will help us to produce more, to implement expansion plans and resume activity in the marketplace at a faster pace.
Experts say special attention is rightly given to this important sector, as it accounts to about 26% of the country's GDP and will benefit 126,000 companies that need a shot in the arm to increase production levels and exports. Yes, Hakim for CGTN, Cairo.
You're watching Global Business Africa. Time for a short break. Here's what's coming up next. We'll explore developments in the oil market following yesterday's OPEC Plus meeting. And the construction industry in China is going carbon neutral. The details coming up next.
Change is on the horizon. Through the shifting of time, Africa's emerging tech landscape is creating new channels.
There's a hunger for local African content globally.
Shaped by innovation, carved out by a new generation of digital entrepreneurs, sculpted by a mobile revolution, and trickling down to the most remote corners of the continent. TechSpot is seeking out the new concepts in technology, disrupting Africa's traditional sectors.
business in Africa is at a crossroads. We celebrate those who are adopting and thriving despite the challenges, from grassroots to big businesses. Global Business takes you along for the ride as we track the making of a giant. Only on CGTN.
Welcome back to the program. Now, oil prices did climb a bit on Friday after the producer group OPEC Plus said it could review its production hike policy at short notice. That's if oil demand effectively collapsed due to a rising number of pandemic restrictions in key markets. Now, OPEC Plus did surprise the market on Thursday when it stuck to its plans to continue adding 400,000 barrels a day of output every month, effectively raising outputs next month by 400,000 barrels a day. But producers did leave the door open to changing policy swiftly if demand suffered from measures to contain the spread of the Omicron coronavirus variant. They say they could meet again even before the next scheduled meeting, which is set for the 4th of January. For the week, Brent was poised to end about 1.7% lower for a 6th consecutive week for the first time since November 2018. WTI, on the other hand, broadly stable in the week after 5 weekly declines. All right, then. So Brent at the moment is around $70.20 a barrel. Let's get you an update on what's happening in oil markets after Thursday's meeting. Vincent McAvaney joins us now live from London. So, Vincent, the markets have had a bit of a day to digest the outcome from the OPEC meeting, to consider what's happening on the pandemic front as well. Brent and WTI went as low as 65.70, 62.40 a barrel in yesterday's trading session. But is the view in the market generally that demand is much weaker than OPEC Plus is assuming it is?
Well, crude prices have climbed about 2% today after OPEC Plus surprised the market yesterday by sticking with that policy to increase production by 400,000 barrels per day in January. But OPEC Plus also said it could review that policy to hike output at short notice if oil demand collapses due to a rising number of pandemic lockdowns. So that is perhaps acknowledgement that the Omicron variant is now having to be factored into plans. And the market is watching closely to see whether citizens in European nations like Germany and Austria do now take up the vaccine with these restrictive mandates. Other European countries will also be tracking whether it works and is the right thing to do to boost the vaccination program. So that could also result in a further drop in demand. Reuters has, though, seen an internal report which shows OPEC Plus could be headed for a surplus glut in the first quarter of 2022. But so far, the impact of Omicron has mostly been seen in jet fuel. Now, on top of that, President Joe Biden has today said that China could release more oil from its reserves, although it has not done so yet, claiming that decreases in gasoline prices after the US released from their reserves are beginning to reach Americans. And that's something that's being seen in Japan and India, which have also followed the US lead on this.
Indeed. So that's the demand side of it. But what about the supply side? Because OPEC Plus has set this output target of around 40.5 million barrels a day of output for January. But can the group really hit that goal? I mean, some key members here in Africa, Nigeria and Angola, their oil output was 20% under the January quotas between August and October.
Well, OPEC Plus has regularly failed to meet its output targets, producing about 700,000 barrels per day less than planned in both September and October, according to the International Energy Agency. Last month, they undershot the planned rise, which brought that lack of capacity in some producers into focus at this week's meeting. What we're seeing is many smaller producers can't raise supply, and others have been wary of pumping too much in case of creating a glut with a drop in demand from renewed COVID setbacks. But last month, the biggest rises came from OPEC's top two producers, Saudi Arabia and Iraq, which both boosted output largely as promised. Kuwait, the United Arab Emirates and Algeria also made increases, and Nigerian output, often hit by unplanned outages, also actually recovered in November. But as you mentioned, output declined or did not increase in not just Angola, but also Equatorial Guinea and Gabon, owing to a lack of capacity to produce more. Now, the biggest decline, some 50,000 barrels per day, was in Angola, where exports hit a record low during, and that was down to the tanker schedules, it seems. So Saudi Arabia could increase output to get closer to hitting that goal. Many analysts actually believe Crown Prince Mohammed bin Salman is intentionally failing to meet targets, which could bring down the price as part of a strategy to force President Biden into meeting him in person, something the US president seems reluctant to do as he resets the two nations' relationship after the Trump years. And of course, the other factor to remember through all of this is all the producers, like every business around the world, they're being impacted by the global supply chain crisis. Investment in these facilities and repairs will have dropped off last year when the prices slumped. Now bringing operations back online, producers big and small may be struggling to get the parts that they need to do that.
Indeed. One last question for you. So OPEC, of course, did point out that the meeting is still technically, it's still in session until the next one, which, well, is currently scheduled first week of January. But what should the market read into that?
Well, I think, again, that's just renewed caution on how COVID recovery is going around the world. We always knew in many big consumers the winter months were going to see setbacks in the battle with the virus, which could affect demand. But add to that now the Omicron variant and the willingness of European leaders, it seems, to force new lockdowns and mandate vaccines. And it's hard to predict what demand will be like at the start of 2022. So they're seemingly keeping their plans fluid.
Indeed, we'll leave it there for the time being. Vincent McAvenny there live in London. Brent futures due in February essentially have now gone under $70 a barrel, 69.82 at this point in time. Now, on to Hungary. Fuel price caps over there essentially means that petrol means gas for less when motorists from neighbouring countries drive across the border. And it's sparking a rise in so-called fuel tourism, where the fuel price cap was introduced back in mid-November in order to help citizens cope with rising prices when inflation hit 6.5%. Linda Kennedy reports from the border between Hungary and Slovakia.
Esztergom is a popular town on the Hungarian-Slovak frontier, but it's attracting even more visitors than usual. Fuel tourists are crossing the Danube to buy cheaper fuel in Hungary, where the cost per litre has been capped at €1.3 or $1.5. It means less outlay for Slovakian drivers who come here to fill up.
I save at least €5 to €6 on a full tank. That's pretty good. Since I drive quite a lot, I save the price of 2 full tanks a year.
The average euro exchange rate is about 366 forints. If I split it with that, it's well worth it to fill up here. It's definitely not €1.50 here, because we have 1.5 euros for 1 litre of fuel.
While Slovakian car drivers save most, around €6 or $6.8 for a full tank, fuel tourists are flocking into Hungary from all its neighbours. The managing director of the country's best-known fuel price comparison website says fuel station owners are reporting similar experiences.
I talked with them in the last few days, and in the southern part of Hungary, from Serbia, many people are coming because the price difference can be more than 30, even 40 forints per liter. So they can easily cross the board there and come to fuel.
That price means a saving of €5.3 or $6 for Serbians filling a 50-litre car tank. The discount for lorries is bigger, around $135 per tank. But there's a high cost for air quality both at the border and more generally.
If there will be more fuel consumption, it means there will be more air pollution. This is especially true for trucks because, for example, if a big heavy truck fills its tank in Hungary, it can go all over Europe to Portugal without refilling their tanks, and they will go with this cheap fuel and pollute the air without paying for this cost.
Back at the Danube, traffic from Slovakia keeps coming despite the 2-week lockdown imposed on the country. When it's lifted, the number of fuel tourists crossing to Hungary is expected to rise.
The fuel price cap may be extended beyond its original 3 months, the government has said. Motorists and truckers from neighbouring countries are already placing extra demand on Hungary's domestic fuel supply. An extension brings anxiety. That pressure may increase. Linda Kennedy, CGTN, Esztergom.
And that right there is a real-life example of arbitrage. Now, on to China. The construction industry there is a key part of the country's urbanization and also its economic output. But getting the industry to go carbon neutral is a major issue. Our reporter, Jiang Shishuan, is at the ongoing Beyond Tech Innovation Expo in Macau and finds out how companies are dealing with it.
People now spend 90% of their life living in buildings, whether it's your apartment, your office workplace, or a restaurant. But you may not know that it is these buildings that generate almost 40% of carbon dioxide emissions around the globe. So turning it into green businesses is in urgent demand for the sake of people's health and for the environment. So how are the construction giants doing on the way to carbon neutrality? Just last month, the first building project to realize carbon neutrality in its construction process in Hong Kong was completed by China State Construction International. At the Beyond Expo, the company is showing off its green technology for the construction industry.
The most significant one is MIC, which is modular integrated construction. It's a kind of new tech that help us can produce a house just like produce cars in a factory. So based on the calculation, we found that MIC technology could help cut timber use by 80% and construction waste and noise by 60%.
The company introduced 5 brand new construction tech products at the expo today. Those include the quick construction solution of modular integrated construction and a hyperbolic wall tech solution with major R&D achievement in fabrication information modeling. And being low carbon doesn't mean a sacrifice in efficiency. Actually, those green technologies have proved to be increasingly efficient. This infection control center in Hong Kong with 136 negative pressure wards was completed in just 4 months last year, far faster than the 4 years that might have been expected with traditional methods. But it's not just construction. The whole life cycle of a building needs to turn green. And so a Hong Kong-based consulting firm that specializes in offering digitalization solutions, ISBeam, is showcasing how it helps builders consider a building's entire life cycle, from design to procurement to building and operation.
Of course, the most important one is to go to the operation. From the digital solution, they can predict from the AI, from our digital data, the whole building life cycle performance, so they can manage the building better. From the carbon perspective, most of our energy is used in our operation phase. So if we can, from the simulation, from the digital wise, we can simulate a better world.
Lee says the demand for builders to digitalize began some 5 years ago. But it's really since the COVID-19 outbreak that the whole industry has seen the current surge in demand, so that planners can supervise projects from their homes, hopefully from their green homes. Zhang Shixuan, ICS for CGTN, Macau Special Administrative Region.
Now, we explored OPEC's decision-making some 10 minutes ago, so let's dive into that in commodities in a bit more detail. There's still that lingering question about the effective ability of big oil producers here on the continent, especially Nigeria and Angola, to actually meet their production targets even next month. In the 3 months to October, their output was around 20% below the January 2022 target, and there's a significant maintenance backlog to contend with. The prices have also been responding in a rather interesting way. Brent and WTI were almost 2.7 and 2.4% higher at 16.23 GMT, but that gain has been chopped by a fair bit. Brent futures are now down to just about a third higher so far in the day. Now then, the upcoming Somali film Ayanle will be the first film screening in Mogadishu in 3 decades. It's a new 90-minute feature film and it's due for release in February. It's hoping to showcase and to remind all of us that Somali cinema is more than just pirates, refugees, militants and war.
As cinema returns to Somalia after more than 3 decades, this upcoming Somali film is hoping to ride the wave. For its director, Ahmed Farah, it's a chance to show that Somali cinema is more than pirates, refugees, militants and war.
Other people can come and tell, like Somali stories. And whenever they do that, their focus is what they've seen on the news. And the Somali that you know on the news is there, but there's also another Somali that people don't know. And we can always complain that the world is not telling the real stories of Somalia, but it's us who needs to tell, their stories. Like we need to, tell our stories not only to the world but also to ourselves. The next generation need to know, how the 90s was, how the 80s was. I don't even know, how the 70s people in Somalia lived.
The 90-minute film is set in Nairobi's suburb of Isli, home to many Somali families. Its main character, Ayanle, whose name is also the film's title, is played by Somali-American actor Barkad Abdirahman, who was in the Academy Award-nominated films Watu Wote and Captain Phillips, alongside American actor Tom Hanks.
We kind of had the situation, and when we were filming in Isli, there was a scene where we were portraying as Al-Shabaab members, and some of the cops was taking photos, and the cast were very uneasy, and I can sense it. So I asked them what's going on, and they were like, if those cops took our pictures, and later when this film is done, they'll come and interrogate us and put us in jail, whatever, the same situation the main character Ayane went through.
As the story begins, Ayanle finds the American accent he has cultivated results in an expensive shakedown from Kenyan cops. To recoup the bribe, he impersonates a member of Al-Qaeda-linked Al-Shabaab insurgency to scam $500 from a gullible Western journalist. Somali-Dutch director Ahmed Farah wrote the movie based on scams he witnessed while working as a news cameraman for networks like Al Jazeera and UK's Channel 4.
I've worked for many years as a news documentary cameraman, and where I came across a lot of interesting stories. Stories that you hear when the camera is off. And for those years, I used to collect those stories, and some of them were even better than fiction. And those stories happen different places in Africa. And I wanted to tell a story that people, especially from same background, same region, can identify with. So I had to find, how to put that all together and make a movie out of it.
It took Farah roughly 8 years to write, finance and shoot the 90-minute movie. Ayanle is due for release in February 2022. Najma Abdirizak, CGTN.
All right, then a quick run through the currencies here for you. So you will recall, of course, that the rand did get a bit of a beating in late November, once, of course, the Omicron variant did come through. The cases we're seeing in South Africa so far mostly mild, according to the country's health minister. Just last week, the country reported around 585 new cases. Yesterday, over 11,000 new ones were reported. So we're seeing the new caseload going up very steeply, but the hospitalization rate is still pretty muted. Hopefully it remains that way. From the 25th of November to date, the rand has lost about 0.6% of its value against American dollar. On a year-to-date basis, it's around 9% weaker. Those are your currencies, and that's it for this edition of Global Business Africa. As always, we'd like to hear your thoughts on the content you've seen on the program in the last hour. Better ways to get your thoughts back to us, all of them on your screens right now. I'm Ramah Nyang in the Kenyan capital, Nairobi. Thank you for your company in the last hour. The World Today is up next from Washington, D.C.